In this lecture, we're going to be looking at ascending and descending triangles. So first off, ascending triangle, what is it? So it's basically when you have prices going up and they're being wedged in a way. So you have prices going up here and they're hitting a level, which is a resistance level that's stable, okay? But then every time they're going back down, they are supported by buyers. And then it's going back up, but then sellers are selling at the same level, okay? So they are as confident in this level. Now, as prices are going down, buyers are being more aggressive. So they're buying at higher prices. So the lows here are getting a bit higher. And then prices goes up and sellers are consistent about their price, pushing it lower from here. And then they keep pushing it here. But buyers keep pushing their buy orders higher. So then the price is getting wedged in a way, okay? The thing is, you can see that sellers are very robust on a level. There's a lot of sellers on this resistance level. Buyers are being more and more aggressive. So what usually happens, and it's not always the case, is in a ascending triangle, so a triangle that's going up, buyers will win at one point and the sellers are going to be completely executed. They're going to sell whatever they want to sell, and buyers are going to push the price higher, and then the price will explode in this direction. Now, you never know if it actually will or will not. Sometimes sellers actually win, buyers are exhausted, there's not enough of them, and prices go down. So when you see an ascending triangle, the right way to play it is wait until there is a break. And if the price breaks above, then you can get in here, expecting the price to go higher. Now, if it doesn't and it breaks below, then you can get in on a short position, expecting the price to go lower. Even though there is more likelihood that it breaks up, it's a smaller likelihood, right? You always want to wait until the break to get into a position whenever you're looking at any type of triangles. So this is the ascending triangle. The descending triangle, we'll actually draw it here, is just the inverse, okay? So you would have a chart and you would have the price of your currency here. That's basically going down in a way, and it's hitting a level, and then it's going back up, and it's hitting back the same level, going back up, hitting back the same level, going back up, and you can see here that there is a triangle here, and this is, I guess, straight, and the triangle is dropping here. Right? So the price is getting wedged here, and at one point it's gonna break. Now it could break either way, but it's more likelihood in a descending triangle that it breaks down. And this here, which is the support level, which was supporting the price at multiple times, once it breaks, it becomes the new resistance, and prices might tumble down. Okay? Now you never know if this is going to happen, so you always wait until this happens so you can enter your position after it breaks, right? Because you don't know, it could have broken up, right? The price might have broken this way. Let's get the same color. Might have broken this way, right? So you never know. And this is why you want to wait until the break before getting into a position. But this would be the descending, right? Descending triangle. The other one was the ascending triangle. These ones you want to look out for because they happen often, and they can help you in getting, an entry and an exit, and then moving on to your next trade. That being said, I'll see you guys in the next lecture. In this lecture, we're going to be looking at symmetrical triangles. Now, the only difference between symmetrical triangles and ascending and descending triangles, it's that basically both supply and demand are being more aggressive. So instead of having, a resistance level that's flat, like in the ascending triangle, where, sellers are selling at the same price, or a support level that's flat, like in the descending triangle, where the buyers are buying at the same level, so there's a support. In this situation, both buyers and sellers are being more and more aggressive in their prices. So as you see here, you can have something that's going up, and then sellers are, coming in, pushing prices lower. Then buyers are coming in, pushing it higher, sellers coming in, pushing it lower, buyers coming in, pushing it higher, and the price really gets wedged in between. And at one point, one of them is going to win, either buyers or sellers. And the further the price goes within the triangle, I'll try and explain it here, the more the explosion could be bigger, right? So let's put it up here. Imagine this. Imagine I have prices here. I have a triangle. And then I have prices that are fluctuating. Let me actually draw the triangle here. It'll be easier. Okay. Let's actually take this off. Let's say I have this triangle. Okay. Imagine this. Imagine I have prices. Buyers pushing it up. Sellers pushing it, buyers pushing it. Now, if I break here, okay, prices might tumble because I have this triangle, I kind of see it. But imagine this. Imagine the price actually goes all the way within the triangle. So it gets wedged more, right? Buyers push it, sellers push it, buyers push it, sellers push it. And, we get really deep within the triangle. Once somebody wins, either the buyers or the sellers win, so the explosion is going to be way bigger than if we broke somewhere around here or around here. So the further we go within a triangle, the bigger the explosion could be. So this is what we would call a symmetrical triangle. It's basically a triangle where both supply and demand are being more and more aggressive. You can't truly know which way it's going to break. So you always wait until the break happens as a confirmation, and then you can enter your position in that same direction. That being said, this is symmetrical triangles, and I'll see you guys in the next lecture. In this lecture, we're going to be talking about wedges. So again, wedges are another type of triangles. And you know what? For me, I see all of them in the same way, right? I don't remember, this one is a wedge, this one is a symmetrical, this one is because it's all the same thing. It tells me something about supply and demand. And this is why I really like these chart patterns that have to do with triangles. So a wedge is basically another type of triangle where it's not very symmetrical in one direction, it's not symmetrical in the other, and it's not symmetrical in both. It's just a triangle. Okay. So you can see again where you're going to be having supply or buyers buying at more and more aggressive prices, sellers at more and more aggressive prices. Now it's not going to be symmetrical at all. So maybe buyers are going to be way more aggressive in their buying and sellers slower, less aggressive in their selling, but not, in the same way as a ascending triangle. So they could even be selling at slightly higher prices. It's just that both, if you look at the resistance level and the support level, they are going to meet at one place. And that's what we call a wedge, because the price is going to be wedged between them at one point, right? And the same thing with the triangles. The more the price gets wedged further within the wedge, the bigger the explosion could be. And the same thing that we've learned about resistance and support. When a resistance breaks, it becomes the new support. And when a support breaks, it becomes the new resistance. Okay, so these are wedges. You'll see different type of wedges. Again, here in this situation, buyers were way more aggressive and sellers, fluctuated a bit. So you are going to often see these type of patterns, and these are the patterns that I like the most. The reason why I really like these triangle patterns, and I show a lot of them, is because they are one of the best patterns out there. They make sense, right? So there's a sense why they work, not just because it's a self-fulfilling prophecy and everybody knows them and everybody sees them, but it is a battle between buyers and sellers, and you can see that through the chart. So there is an underlying sense behind them. Second is because they're very easy to see. So when you're doing something, because it's a self-fulfilling prophecy, you want to make sure that everybody else sees it, right? So everybody sees these triangles. And this is the reason why I really love these patterns, and I show them here in this course. Some other patterns that you might have heard of, like head and shoulders, don't really make sense. Because yes, a lot of people know about them, but even though you might say, well, because they know about them, it'll work just because it's a self-fulfilling prophecy, they're very hard to find, to see. And if nobody really sees them, or not everybody sees them, then that self-fulfilling prophecy isn't really going to hold. And second, something like head and shoulders, well, it doesn't really make sense, right? So even if there was the self-fulfilling prophecy part of it, the sense, the logical part behind it isn't strong. So I don't want to look at patterns like that don't make too much sense and that I haven't seen work really well. I want to look at patterns like this that are easy to see and that have logic and sense behind them. And this is why right now we just looked at wedges. Keep an eye out for them. See if you can find some on the charts that you're trading. And this is going to be it for wedges. And I'll see you guys in the next lecture.